Okay, we've got Rohit Srivastava joining us this morning as well for a look at things. Rohit, let's take a look at those levels, that we were talking about earlier today. The kind of crack we've seen now in the last couple of sessions. How are you reading into that at this point? Where are you really expecting markets to head? More importantly, where's the support, Rohit?
I think the next key level that everyone is going to be watching is going to be 83.20. The first one was closer to 84.80, which we broke, 2 days ago. Our long short fund has essentially been short over the last 3 days. Now, the level that I think most of the market will watch will be 83.20 simply because it's the low that we made in July from where we were bouncing back. And what happened in that is essentially the Nifty did not go beyond the high that it made in July in August. Whereas the mid-cap indices did, so that caused a near-term intermarket divergence and also forms a very short-term head and shoulders kind of structure. So breaking the 83.20 mark would set us up for dropping to around 81.90, which would also be around 61% of the entire rise. Now this is all very short term. What tends to happen here is that if you do close at these levels by tomorrow, which is the week. The 20-week average is at around 8396, and if we stay below that, then the setup that we discussed, I think more than a month ago, we were discussing the larger degree head and shoulders pattern with the 8000 neckline. That pattern again comes into play because all we've done in this bounce back is retraced around 61% of the fall of the previous quarter, where we fell from say 9100 all the way down to around 7980, and then we've retraced 61%, which was at 8660. And we were unable to go above that. So in that sense, we are still forming a right shoulder, and that entire pattern, which is far more bearish, remains as real as it was. And this huge intermarket divergence between mid caps and large caps usually occurs at major turning points in the market. So it's an advance warning that something much more worse may be coming ahead. We'll need a couple of more confirmations, but the near-term momentum indicators have all turned to the sell side, so we continue to look for lower levels.
In regard, I remember talking to you yesterday, Rohit, and you were highlighting that the Bank Nifty is probably one of those major indicators that's already turned negative in terms of the way it's taken out the July low as well. What's your reading when we talk about the Bank Nifty? What kind of levels could we now see in the immediate term when we talk about that index? And is that going to be the big spot of weakness?
Yes, the Bank Nifty has been the weakest of all the indices when you put them all together, because it peaked first, which is at the end of January, it made its highest level, and after that it's been making lower tops for the entire 6-month period. So in that sense, it has remained the weakest, and even in this sell-off, like we discussed yesterday, the Bank Nifty has broken the July low, so it's already made that minor head and shoulders, indicating that we are heading to maybe around 17,400 in the very short term. But the big picture there too is that because we failed to go above this 19,100 level almost 3 to 4 times now over the last 3 months, the indication is that we might and retest.
All right, we'll just get back to Rohit in just a moment. That's his take on some of those levels. Okay, we've got Rohit back with us, I think. Rohit, if you can hear me, then just do finish your thought there. All right, we probably don't have that line yet, but those are some of the levels that Rohit is tracking right now. He's saying sell Nifty on the rally, and a close below 83.20 will confirm the onset of a prolonged bear phase. So that's why those levels are critical today, and that's why we've been talking about them since morning. He has said that if we do then crack that level, the Nifty can slide lower than to about 7,200, and that's again something that we have been hearing from analysts. So important for the market to find that support. Rohit, just to let you finish the thought that you were of course saying earlier.
Yeah, I was talking about the Bank Nifty, and like we said, it's been giving us lead indications. The immediate target is at around 17,400, and we will be looking for further confirmation. But the sense is that because it's leading, it could retest the June lows, and then we could be looking at a target of around 16,000 overall.
All right. So in that sense, and beyond the banking pack as well, Rohit, are there any other pockets of weakness that you're seeing when we talk about the sectors or themes that probably start eroding? Because we've seen what's happened to the metal pack. I mean, that's been the direct impact of the way global cues have been panning out. What else do you see as somewhat of a weak factor here, and you'd advise clients to avoid it?
See, I think it's possible that we've reached the point where you will probably need to avoid a very large part of the market, and the reason is that this recent outperformance of mid caps to large caps has become an intermarket divergence. If the large caps showed the sign that they could catch up with the rest of the market and head to 9200, it would be great. But because we haven't got that indication yet, and if by tomorrow we are staying below 83.96, then the sign is that this is a medium to longer term top, which means that apart from a few defensive sectors, and usually that's pharma, even FMCG I think could be weaker. That means that you'll need to start avoiding even the best performing stocks for some time, essentially for a technical correction. And therefore, in the near term, we would really ask people to remain hedged or maybe book profits wherever they can. And look for much lower levels. So you would even avoid not just the best performers or the worst performers, but also the best performers.
Since you brought up the factor that there will be some bit of churn, one probably needs to hedge as well in this kind of a scenario. The only spot of green has been the way the IT pack's been panning out. Yesterday also you saw some bit of gains coming in. Any thoughts on the large cap IT sector and any play out here when we talk about the IT space?
Yeah, the IT sector is interesting. While in the longer term, I have concerns, but in the near term, TCS is broken out of what looks like a triangle. Even Infosys has gone beyond its key retracement. So there's a possibility that, because of the currency moves, if the market has to go somewhere, it might start pricing in gains into the tech sector in the short term. So if you're trading short term, maybe for a couple of weeks time frame, I think it's possible that the tech sector continues to head higher. Infosys and TCS would then I think be the key winners from the big stocks, both of which would probably try and attempt to go past the high that they made 2 months ago. So that signal is there that they can do that. So I think apart from pharma, yes, tech would be the other sector which might give us near-term positives.
Since we're talking about the tech space, it's interesting to see what's happening in the currency as well. One can't really ignore the kind of move that we've seen on the rupee. Yesterday it almost touched 65 as well. Today that's going to be a level that we'll be watching out for on opening itself. But what's your sense, Rohit, in terms of the way the currency's been panning out since you track the charts and you've been tracking the currency also pretty closely? What's your reading of it?
Yeah, so my sense has been that the USDINR essentially is in a long-term uptrend, and over the last 2 years we've actually managed to keep it subdued for a very, very long period of time. And what I mean by that is that we really not participated in the global dollar rally. So I think the last place holding out was essentially India and China. These were the two markets which were not participating in the dollar rally. And my sense was for some time that if once China starts moving, then I don't think India can really hold back. And we've seen the first impact of that in the last 2 days. And in doing so, we've gone beyond the 64, 20, 30 mark, which was the main resistance for almost, I think, a whole year. All the attempts to go above that level have failed. And after that, we even fell to 59 at one point of time, and then several attempts over the last several months. So this is a breakout. I think it's a meaningful breakout, and we would look at buying it. You should look at buying it every dip if you're trading the USD-INR. The question then again remains speed. We've seen a fast move in the 2 days before us, but I think we'll head higher. Whether we do it very fast or slowly will really depend on how the moves in the yuan itself pan out. But the yuan itself has also broken out of a double top resistance level that was holding out for most of the last 1.5 years. So that's also significant. So we are looking at a major rally in the dollar developing, in which now we can't really stay out of. The question is really going to be at what speed we are going to move. And the near-term target which I've put out now is around 65.70. That should be the next target over the next couple of weeks.
All right. Rohit, thanks so much for joining us. today and taking us through some of your strategies.